Okay, good day, everybody. This is Jim, the option professor, and I'm going to be with you for the next 45 minutes. I'm going to explain a little bit about what I do, how I do it, platforms I would use, and how we help people with their option trading. Before we get started, just make it clear as a bell that obviously today I will be sharing my opinions and my views. I'll be talking about markets and giving my opinions and my views. But again, you should always be consulting your brokerage firm about your suitability and risk tolerance. And today we'll be not making any advice to anyone because obviously that's for your brokerage firm and yourself to do. But I am going to provide you with information that I think is valuable and methodologies that I feel have merit. So hang in there with me. A quick background on myself. I'm a graduate of Boston College. Yep. And I've been in the investment arena here for many decades. I have traded thousands and thousands of option contracts, millions of dollars in both options and stocks. And so I went to the Options Institute in Chicago for advanced training. And so I consider myself a fairly knowledgeable source on the options. And as far as an educator is concerned, I've done seminars pretty much in all the states as well as Canada over the decades. So I have educated thousands upon thousands of traders on options, and I try to help them every day with their challenges that they have, both doing short-term options, DTE and weeklies and whatever, to doing the credit spreads. I mean, a classic example of the problems with credit spreads on the risk side is what happened yesterday. You go around and you think you're selling these credit spreads in some kind of a sure deal. You've heard all this talk 8 out of 9 times or 9 out of 10 times it works. And obviously, one day like yesterday can, not only wipe out any gains you might have picked up, but jump right into your principal. So, I know how to do the credit spreads very well, and I know when they get in big trouble, and I try to avoid that. And I try to do the credit spreads on a timely basis, not on a robotic basis. And I think when you do anything robotically, you're going to be in big trouble because the markets are a self-correcting mechanism. Anyway, so I think I can help you here, and that's enough about me. Let's get into what's going on with the markets. Now, I'm very proud of my alerts that go out every Sunday night because it goes into questions I think you should be asking yourself every week, and also market reviews on everything. So I'm going to get into the algorithms and also the platforms and stuff in a little bit. But I do want to talk about the markets itself because I'm very, very happy the way we have been reading the tea leaves. Um, with regards to the S&P, I'll just give you a quick synopsis here. Um, and then I'll get into how I come up with this stuff. Okay, so on the S&P, you can see on a long-term basis, the concern is at some point you're going to get a reversion to the mean. And that could be 5,500, or it could be 5,000, or it could be 4,700, something like that. So that's a potential occurrence, just like it was here. But we have no evidence of a real turn yet. Now, let me show you here on the 5-year graph. Okay, still in an uptrend. You hit the green line, boom, that's a buy zone. So far, it's still there. Now, yesterday and recently, let me show you what I got. I made it very clear to people that this area here on January 13th was an area of which to do very aggressive buying or call activity. Why? Because it's hitting a moving average that I use that does not get hit very often. This is the last year. So this is called an unusual price. And if it's a low price and it's unusual, it's called an unusually good price. And then once it got above the red, which is right here, and turned up at 5,900, you were all clear. But I also warn people that when you get a market that either goes way down quickly, like this one did here, or way up quickly, what that indicates is an order imbalance. And what does that mean? That means everyone is selling, right? And everyone is buying. So what's the problem with that? The problem is that liquidity providers, which means somebody's got to be the other side of the trade. If everyone is selling down here on January 13th and the S&P is down 50, which it was, somebody's got to step in there and buy. And it's going to be the market makers. And who are the market makers? The Citadels, Goldman Sachs, and guys that make market. Now, When they're the market makers, they're putting up their own money, right? Do you think they're going to step in front of a freight train of selling and not drop the bid down to a point where they can what? Feel somewhat comfortable about writing a check? Of course. And that's why this area here got tested at 57.73 on Monday, January 13th. And that was the bottom because then the CPI came out. And after the CPI came out, what was all the volume doing? Everyone was short covering. Everyone was fear of missing out, FOMO. And so the buyers just flooded the market. And who were the sellers? Well, who are the liquidity providers? Because those are the guys who have to provide liquidity when the entire planet is buying. And what do you think kind of a price they're going to put up there for you? Well, if they're going to be responsible for the sell side, they might take a spot like the all-time high, and maybe they'll put their offers up there. And obviously they take in all the volume, and either the volume dries up or an event occurs, like we saw with the announcement of the challenge to NVIDIA's, well, it wasn't a challenge to NVIDIA. It's a challenge to NVIDIA's chips. It was a challenge to all the data centers they're supposedly having to build. It was a challenge to all the energy that we're supposedly having to have. It was a challenge to the entire AI boom. But it could have been anything, because once you go up that fast on a volume that cannot continue, and the prices are up here, you got to find new people to buy up here, or it's got to come back down under its own weight. Now, where did it come down to? Right down to where I would say it would stop. And where was that? Well, you can see my red line right there comes in at 59.83. The low is 59.63. And it closed well above 59.83. And it's back above the blue and the red, and they're looking like they're going to cross. So while everybody is going nuts that it's going to collapse, unless it takes out this number here, it might even take out that high before you know it. That's how technical analysis can make people walking down Main Street go, God, how'd you know that? Well, we don't know anything. You have an algorithm, a recipe of what you follow. And it's if it's a recipe that puts too much salt in, or if it's a recipe that, doesn't put enough meat in the soup or whatever, it's not going to taste right. So obviously anybody can have an algorithm. The question is it accurate? Is it effective? Is it consistent? And can you count on it? In my view, what I use hits all those buttons, or else I wouldn't be using them. There's a lot of things out there you can use, and I'm not saying I don't listen to it all. But after I listened to it all, it had better concur with what I'm doing, or I'm not doing it. And that's the discipline. And without the discipline, I think you're in kind of trouble with the markets, right? Okay. So anyway, I just wanted to show you what I saw and what I see now. And basically now you know exactly what I'd be telling you, which is what? If we take out yesterday's lows, we can go down to 5,800 again. If we take out 5,800 again, you could even go down for that full Monty correction. What's the full Monty correction? 5,500. Where did I get that number as well from? We go over to the 5-year graph. Working a little slow here for me today. Give me a second. There you go. This one comes in at around 57.20. So you could go 57.20, 5,500 if we take out 5,800. Okay. Again, that is still an uptrend. It's been in an uptrend since October 2023. One thing you want to keep an eye on is the money supply growth. Money supply growth went up 27%. Imagine that, expanding the money supply up to 27% and the Fed balance sheet to 9 trillion during COVID. Totally historic. Then it dropped the money supply all the way down to minus 4.8%. And then we turned up again right here in what? October of 23. And the money supply went from -4 to now it's not only in plus territory and pointing up, but it's also higher than the inflation rate. So they are, the money is being printed or eased or whatever that means when the money supply is increasing. But asset prices do pretty well, as you can see, when money supply growth is growing. And although this might be a little excessive on the money growth we've had, the fact that it's money growth is kind of saying they want asset prices to rise. So basically, that's something very interesting to see as well. Money supply turned right when the markets turned. Money supply has been growing ever since, and so have asset prices. See, when I talk about algorithms or my recipe, it includes technical analysis, but it also includes watching things like what are the interest rates doing? What is the dollar doing? What is the money supply doing? What is the inflation rate doing? Right? How is the interest rate versus the inflation rate? How is the price of gold reacting to this? There is a lot of things I keep an eye on because after decades of doing it, I have the ability to assimilate quite a bit of information and then reach a conclusion. Okay, so again, let's go into some of the other things that I like to look at. These averages, are no magic. My interpretation of them is my own, right? Everyone can know what a moving average is. How do you interpret it? My interpretation is this. When I've got the red is obviously the shortest term, green is second, blue is third, and then purple and gold. My feeling is as pretty simple as this. If the red line is turned up, the short-term one turns up, that tells me the trend is turning up. If the green and the blue are following suit and they are inverted to the upside, we're probably going on a long run. If we ever go down to the purple or the gold, that means we're having what they call a unusual move. Now, if it's an unusual move to the downside, then that would mean it's a very unusual buying opportunity. Now here, once it breaks purple, it's telling me the sellers are definitely in control of this thing. Okay. But the gold tells me that's the last stand. If you broke under, well, I'll show you a good example. Let me show you the 20-year graph. You see when we broke on COVID here? Now that's the first time it went anywhere near purple, which is an excessively low price because this is a long-term average. Ever since, now the only time you ever broke gold was back in 08. You know what they did? That was the great financial crisis where the world was looking like it's coming to an end. And they discovered something called quantitative easing, which means print money and buy your own stuff. Japan's been doing it very, very much. It also kills your currency possibly at some point. But here's the deal. Ever since QE, rather than having moderate financial markets, we've had what? Ridiculous, right? And then we had this crash. And what did they do? They set up 14 entities to start buying things like junk bonds or mutual funds or whatever, municipal bonds, whatever, because they see it down here at a crisis. Because if you go under purple and gold, you're probably going into the Great Depression, right? And that takes a long time to come out of. So they increased the money supply by 27%. They put the balance sheet at 9 trillion, and they got it going back on the bicycle. And obviously they printed too much money because look what they've done. And look what the inflation did, right? So obviously they overdid it. And now we're up here in Zanzibar. And obviously, valuations are way off the chart. The Buffett indicator is way off the chart, but you don't fight the tape. I've been around for decades. You don't think I've heard about the Elliott wave theory? Of course I've had. Elliott wave says we're going to have a big crash. Well, you know what? If you say something long enough, of course it will happen. But I'm not going to be interested in a crash until I have evidence of a turn. And I don't have that. And that's why I'm not fighting the tape, even though I believe we should be reverting down here at some point. But the point has not even shown. Even if you look at these times when it goes down, this is a monthly graph. Okay, it tops out 1 month, then you got another month nearby, and then you got another month underneath, then you got another month. This doesn't happen overnight. Okay, the only time we ever had something really happen overnight was COVID. So if they announced something cataclysmic like a nuclear bomb just hit the LA or something, then obviously it could go like that. But the bottom line, though, is generally these things take a little bit of time. Look at the 08 crash. Come on, the thing was topping out. It got under the red line. I mean, you got warning signs all the time. If you're still in there down here, it's your fault. This one here was more of like a smack in the back of the head you weren't expecting. But if they get that, look how they react. I mean, one thing these guys will do is they'll print money and get this stuff back on the horse. I think they proved that right here. But this is a little bit rarefied air. I mean, again, there are people calling for 6,600. I can see it. 7,000. I could see it. Because why? Because they printed so much money and money's all over the place. I mean, you go up to people, are you a millionaire? It's like, oh yeah, you, of course. Yeah, everybody. How much your house go for? Million? Oh, really? That's all? I got 1.2 million for mine. So the money has just gone crazy. And that's of course why Bitcoin is having such a good time of it as well. Because anything that has limited quantity, whether it be the Mona Lisa or Starry Night or some coin or some diamond, rare, people pay up for it because everything else can be printed. I mean, just think about it. When they split a stock, they're actually increasing the amount of shares by 100%. That sounds like a lot of printing, right? And then basically, with regards to the money supply and the national debt and the deficit. So bottom line is like I say, no evidence of a drop yet. If you want to get bearish, try to get yourself some evidence. These things can't be pointing like this if it's going to be a downtrend, right? So you've got your numbers here. Can you stay under 59.86? Looks like it can't right now. Can you get under 58.56? Can you get under 57.20? Can you stay under there and make the trend go down like it did back here in 22? No evidence of that yet. This could be 2026 for all we know, but that's called conjecture. And we don't invest on conjecture. That's called just abject gambling. Okay. So again, don't fight the tape. Don't go asleep at the wheel. Basically, that's what I told people, be bullish, but be careful. Right. Okay. So again, that's where we are looking now. And that's why I think the information that I've been providing has been very accurate, and people who subscribe to the newsletter should have been doing quite well by just following along the market review that I give every week, and also the big questions to be asking every week. Like this week, obviously, is what? Can this rally last, right? Is this just short covering that won't stick? And of course it was. And what is the Fed going to do? It looks like it should be pausing. So if they start cutting, that would make people think maybe Trump is in control of the Fed. Again, taking a look at the bond market, which again, I think the information I provided has been very helpful, because here's what I saw there. In September, they cut 50 points on the what? On the interest rate, right? 50 points. And everybody said rates are going to go down. And you know what I told everybody? I said, this is the best time to short bonds I've seen in a long time, because we've had a reversion decline to 360 on the 10-year note. And this is going to be about as low as that yield's going to get if this trend holds. And I think it's going to hold. So sell the hell out of bonds. And now we're way up here. So the trend for interest rates is still up. And the reason it is we have a $2 trillion deficit, and he's trying to figure out how to cut it. And he's talking about getting rid of FEMA, and he's talking about freezing all these donations or whatever, these nonprofits or whatever we have going out. So he's looking at doing the balancing in kind of a weird way. And if it's going to be by firing everybody and closing everything down, you have to wonder if that's going to affect the unemployment rate. And if the unemployment rate starts rising, people could start thinking their jobs aren't secure. And if they think their jobs aren't secure, they're not going to spend as much money. And if they don't spend as much money, they're not going to have as much earnings. And if you don't have as much earnings and you're at 25-to-1 PE ratio, it's going to be a problem. So that's why you got to be careful. Donald Trump is the president, and he's going to make decisions. I just hope that he considers the consequences of all the decisions, as opposed to just feeling like he can do anything he wants and no one can challenge him. That may be true, but that doesn't mean your decisions are not going to have ramifications. And that's where the tariffs are coming in. And I'm sure the Treasury Secretary has told him that if you go nutty with the tariffs, 60%, 50%, 90%, all these crazy numbers, it could have a very disruptive effect on the markets and the inflation rate. So I think so far he's kind of been a kind of tamed lion. Right. But that may change. And if it changes because he's just that kind of guy who just wants to do whatever he wants to do, it may have a very dramatic effect on the markets. Anyway, that's the story on interest rates. Interest rates are in an upward trend, and they're going to be in an upward trend until we can start getting under 4% and keeping it there, and maybe even 3.75 and keeping it there. So that's your numbers. Otherwise, again, why would interest rates go up? The GDP is going to be coming out on Thursday. Or is it tomorrow? Let's see what it says here. No, I think it's Thursday. And it's going to be called the GDP growth rate for Q4. If the growth rate is 2.5 or 3%, right? And then the PCE comes out on Friday. So here's how the math could work. If you're at 3% on the, if you're at 3% or 3.5% on the GDP, and you add to that the inflation rate, which seems to be at least 2.5%, you should be 5.5% on the 10-year, and we're only at 4.5%. So if you ever see it go up from here, it might be because the combination of the PCE on Friday and the GDP on Thursday are indicating a little bit more power than you think. So bear that in mind. Again, hedging is not, I'm obviously an options expert. So, things go way up in price, you can hedge them. I'm going to give you a little hint on how you can hedge them. Now, Tesla's got earnings coming out, but before it did, it had a very big move. And again, when you buy something here and it goes up here, you might want to think about hedging some of that risk, or not risk, the gain. You don't want to walk away, giving all your gain away. So if it goes up here and you think it's rarefied, and now why would you think it's rarefied up here? Well, you might go to the shorter term graph and you see you got kind of sell signals down here. Let's go to the 3-month. Yeah, up in the 440 area, kind of started going down a little bit. So, you could sell the 500 call, take the premium and buy a put. Or even when it's on the real high point, you might say to yourself, you know what? It's at 500 here. This thing has gone nuts. I mean, it's like a $700 billion move after the election. I don't know what the calls were going for at 550 or 525, but I'm sure they were pretty healthy. So you can pick a striking price here above the price, which means you're going to agree to sell at that price, take in a huge premium, and take the premium and buy a put underneath. So now you have what they call a window, a bracket, a parameter around your equity. And maybe your upside potential might be to 550. And maybe your downside, if you bought a 470 put, might have been 470. So the worst it'll ever be for you is 470. And the best it'll ever be for you is 550 until the options expire. Now, you're not going to hear that by calling up some platform. That's why people come to me. Because they come to me with some questions like this and they go, Jim, can you walk me through that thing? That sounded like a pretty good deal. I still make money if it goes up to a certain level, but I got a floor under my equity in case things tank. I mean, we saw some pretty big activity on some big stocks. I mean, people have a lot of profits in Broadcom. Are you trying to tell me, talking to somebody who could explain, hey, listen, it's at 250 on a double top. Why don't you sell the 260 or 280 calls and buy the 240 puts? And then if it goes down here, you have a floor on your equity at 240. Is that a bad deal? Or do you think hoping it goes back up is a better deal? Well, of course it could go back up. Look at a long-term trend. Okay, long-term trend is still up. It's just reverting to the mean, which they always do. They always come back to the mean. That's why when you see something like Tesla at 500 and the moving averages are at 380, of course it's going to be reverting back to the mean at some point, particularly if he announces that they sold less cars in 2024 than they did in 2023. That doesn't sound like a great deal. And right now it's holding on for dear life right there. Can you see? Right there. You don't want this thing underneath well, it's under 390 now. You don't want this thing closing under 390. Look what a trap door could be if things go bad. It's still in an uptrend though. What's the 1 year telling you? 1 year telling you is trying to break down a little bit here. And again, where could it drop? There's that 300 number. I'm not saying it's going to do that because the blue line is still pointing up. You get this thing above 420, it's back on the bicycle. But it's certainly at a critical point, right? And I put this in the weekly letter this week. I said, Tesla's at a critical point. This thing starts breaking under 380. There's a trap door there. Another one was this one that everybody's into, the MicroStrategy. They got earnings coming up. You know what these guys do? They borrow money at 0 interest, and then they put all their money in this. But as I told people, this thing's at a pretty big juncture here at 350. Starts breaking under 350, 250 is not off the table. Likewise, if we can start trading above 360 and then 400, and that Bitcoin gets back on the bicycle, I mean, I definitely believe there could be a 150,000 Bitcoin price, but I'm also a believer that this might come down and fill the gap if it gets weak. And this guy right here could come down and fill the gap if it gets under 100 or 95. So you see where we are now. So if this thing can get under 100 and then maybe 95 here, there's a gap right there. I don't know if that's going to happen or not. I'm going to put my momentum thing up there. I like to look at momentum. Why? I want to know how fast the car is going. I want to know how strong the engine is. If you're above 50, you got a good engine. If you're above 60, you're probably going to start speeding. If you're under 50, you got a weak engine. Underneath 40, you're probably falling apart. So this thing's at a critical juncture too. Right now, it's still positive though. They've had a hard time keeping it down, right? They tried to bring it down to 90, couldn't do it. Back up here to 110, come back to my numbers right here, held it, still pointing up. So right now, there's still a bias for the thing to go up. And if this thing goes up, it probably also makes the markets are probably going up as well. So a lot of markets are at critical points right now. And I brought that to people's attention very clearly. Apple's another one. AAPL. There you go. And like I say, there's no magic to moving averages or any chart or anything else. It's how you interpret them. I mean, like I say, you start singing My Way, no magic to the lyrics, but it's a lot better out of Frank Sinatra's voice than our own, right? It's his interpretation. So here you go. Apple is coming back to the mean. Down here, got above purple. Purple and gold are meeting. There's your line in the sand. This thing gets back under 230, it's probably going back down. If it can't and gets above 245, something's going on with Apple. It's going to go right back up. Could it be that China is going to be nicer to Apple over there? I don't know. Apple's really slipped over there, and that was 30% of their business. So that's a problem. Their AI input into their stuff has been a yawner. So these are two problems. That's why you go from 260 to 220. But they got earnings coming out, and if they pull some rabbits out of their hat, that's why people are short covering going into it, thinking there could be better news. But again, when it popped from 220 to 240 quickly, obviously that's a lot of short covering and FOMO. And look, you're running right into some walls here. So that's why don't get too excited with the party hats until you can do something with 242. And today's high is 239. We're right on there now. Google. Okay, Google's same story. You see right there, held it perfectly, right? So right there is your line in the sand. You buy your calls, you buy your stock, and if it gets under there, you dump. Right now, you're getting a nice bounce. If we can close above 196, 197, then obviously everything's underneath, which is where you want it to be. This thing has an upward bias. And if they come out with earnings on February 4th that knocks them out of the park, which is probably not the worst bet in the world, you're probably going to blow out 205 and really get running. If not, what do we have here? We have a high point here with a RSI about 70. And over here, we're at about 68. That's not much of a divergence. And again, valuation wise, this is one of the better out valuation ones. But you're not out of the woods just yet. You still got to close above this 97 area, 197 area. And Thursday, sometime today, Tuesday is a reversal day. So it's not surprising to me that everything's going back up after yesterday. We'll have to see if it can hold through Thursday. And again, we've got a lot of stuff coming up the rest of the week. Again, we've got the Fed meeting on Wednesday, which is tomorrow, and their decision. My imagination is what? They leave the rates the same, and he goes with the mantra of what? We're going to monitor conditions. If we have to cut, we can do it, and we have to monitor the inflation rate and the GDP, which they're both going to be seeing on Thursday and Friday. So that'll be the story there. And personal PCE is a consumer, income and spending, which obviously is very important stuff. So there you go there. IBM was another one I kept an eye on. They have earnings coming up, and they're in a big traffic jam, which I think is going to resolve itself very dramatically up or down at some point here. And let me show you that. And there you go. You see, it's a traffic jam. Traffic jams don't last forever, and these things are converging. So right around 220, 225, something's going to happen. Okay, since the trend is up, you would imagine it's going to break to the upside. But like I say, on the 1-year graph, you can see that as long as it's hold 215, and if it can get above 225 and get these green and red lines above blue, then you can go on a very substantial move. If you can't, and for whatever reason they turn down, don't kid yourself. If we start breaking down and something's going wrong with regards to all the Trump ideas or whatever, or inflation or the rates, or oil, and if it starts breaking down, like we saw yesterday, there's a lot of people in the market. And if they all want to sell the same day, and the Citadels and the Goldman Sachs are the only bid, they'll drop it to where they feel good writing a check. They're not going to give you the best price in town if they see an avalanche of buying or selling. They're going to move it to where they feel comfortable. And that I see this happen time and time again. This is my feeling. This is my opinion. With regards to earnings coming out, today we have Boeing coming out. Let's just check a couple of the earnings ones real quick. It might be helpful for you. Boeing. I think that's how they spell it. Yeah, I thought this was going to happen. In fact, I am in this. So full disclosure. The reason I got into this is look at this. You see this and this? That's an uptrend. That's a quiet market. The calls above, weren't going for very much. They had earnings, of course. They had bad stuff coming out, but it's already down. They already know that, and so this RSI looks like it's going someplace. And I thought the calls were very cheap right around here at 170, 175. And until today, I didn't look very smart, but today I look pretty smart. And it's not me; it's just the trend, which was up, has ignited. Okay, so that's basically how I try to look for things. Get them when they're, because I'm a buyer, used to be a seller, used to sell them all the time. I know how the sell side works. I know how to make money on the sell side and how you lose money. The way you make money on the sell side is obviously you try to get a nice fat premium, and then volatility subsides and you collect the premium, and they stay out of the money and you keep the money. That's a lovely story, and it happens a lot. But when it doesn't happen, and when people get in trouble on the sell side, is exactly what happened today with these people. Is you wait to what? The market's in a contracting area here. Premiums are coming down. You keep selling calls or puts because it's been working so well. And then the next thing you know, you're getting whacked. That's how I know it works. And that's why I look for these type of things. And it's not easy to find because they're not all set up that way. But when I can find that setup, I'm a player on the buy side. And you know why I'm a player on the buy side? Because if I risk 150 bucks, I'm not going to worry about it. And if it goes up to 190 and it goes to 500 bucks, that's going to make me happy. And if it goes to 200 or 205 on a real run, that makes me really happy. So again, when I buy the strangles that I do, calls and puts at the same time, or one side or the other, what am I looking for? I'm looking for something that is in a phase where the prices have been kind of quiet and that the premiums are low and the trend looks good. And there could be some news and events occurring that could create volatility, of which are not priced into the market, because implied volatility means the implication of the volatility that has already occurred. And that means what? You try to buy them when they're skinny and you try to sell them when they're fat. And if you can buy both sides for a reasonable price, why not? Then if you're totally wrong on the market, you could be right. I'll give you an instance from last year that this happened, and it happens more than once, believe me. This is Intel. I thought Intel was possibly going to go up last year because it had started to turn a little bit. So let me show you. You see, this looked like it was kind of turning, right? And so they had earnings coming out. And I thought that a call option at 30, oh, it's over here, I'm sorry. Market was flattening out, but you see it's turning up, right? And then it came back down a little bit, and then they were having earnings coming out. So I thought it would go back up towards the purple line, but I put a collar on, excuse me, a strangle on it because I thought that the put was only 50 bucks. And I don't know, I've been around long enough to know, I don't know for sure what's going to go on. So all of a sudden, the put option at 28 was in the money by almost $10. So a $50 bill went to a $1,000 bill. This is what I'm talking about. If you can buy both sides of the market and it doesn't cost that much to buy both sides, why not? Because you don't need just one of these things to make your insurance worthwhile. So again, that's what I try to look for here. I am going to very quickly go over some other markets that I think I've given good information out on. This is the price of crude. Okay, here's my story on crude. When crude was down here, I was noticing that the RSI, the momentum, was still above 40. When it's above 40 and it can't go under 40, sometimes that means that's the bottom. I thought that was indicating a bottom. Okay. Then on the 1 year graph, we got a nice turn up at 69 and bottom line. So I was thinking it was going to go up, which it did. But why did I think 81 would be a problem? Because of right here. You see that blue line? Where's it come in? Came in at 81.88. And what was the high? At 81. What does resistance means? It means get the heck out of everything if you can, right? Or at least hedge it or do something, because that is what resistance means. It means it's a place where it's a ceiling until broken. So that's the story on crude. And crude is still looking okay because of there's backwardation in the futures market, meaning the front month is trading higher than the back, which is indicating tighter supplies. Price of gold, everybody likes that. Let's take a look at the price of gold. I thought 2650 was a very big number, and it was a big number because once it got above there, we accelerated to the upside. So you see this? Let's go to the 1 year graph. And you see where I got it from? See, consolidation, right? This is where the calls are cheap, right? Where's the trend? Trend looks up. Take a shot at the calls. What happens? Boom. Comes back down, holds the red. Boom. Okay. So gold still looks like it's okay. If gold were to get underneath 2680, if gold was to get under 2650, then the party would change dramatically and you could see 2500. That's not exactly what's happening now, though. So I'm not worried about 2500 when it's here, because there's no evidence of it turning down there. So you don't put too much credence into anything until you have some kind of evidence, like here, where it's coming down right to the beautiful, what I say about purple. It's an unusual price. And when it's low, it's an unusually good price. There's a lot of stuff going on in the world. It's hard to keep an eye on everything. So one thing I feel I do for people is I can assimilate a lot of information and then turn it into something that you might be able to use, which I think is what good research is all about. Okay, the dollar index we've also been very good with as well. Why was that? Because when we were up at 115, my longer term chart said we could revert to the mean, maybe as low as this, but is certainly down to here. Now notice we never crossed over the blue, which means this never turned into a bear market. So this is called baloney. This is called take the guy's stock away from, or take the money away from him. Because once it got right back above here, which was 103 and change, we were back on the bicycle. Now, when you go to 110 and the game's being played at 105, you sometimes have a reversion back down, which is what we just saw. There you go. So it's reverted back to the mean, which is around the 107 mark. It could also revert down to this mean if it wanted to as well. But again, ever since 102, you had a very good reason to be long. And even lower than that, 100, 102. So The longer term charts told me what the big picture was. The shorter term chart told me the timing of it. And of course, you want to refine it. You're doing short-term trading, you do the one-day chart. You're doing swing trading, you look at the 5-day and the 1 month. So this is your neighborhood if you're doing short-term trading, and there's your neighborhood if you're doing longer-term trading. But I look at the whole picture because I want to know where I am on the field. Am I in the red zone? I'll probably run a different play than if I'm at the other end of the field, right? So the bottom line is you have to know where you are in the total picture, and you can't do that with a one-day chart. So that's why I look at all different time frames. Okay, I'm going to be coming up to the end of my broadcast here, so I am going to ask you guys to do something, and I think it would be a good thing for you to do. I have a service, options alert service, and it is a weekly service, so it comes out to you in your inbox every Sunday night. I go over my views on the markets. I go over hot questions that I think you should be asking yourself. And then I give some ideas on strangles that I think look attractive. I go over support and resistance on the indexes, QQQ and all of them. I also go over long-term ideas. And we've had some very good long-term ideas, meaning options that are 6 or 12 months out, and leave them alone. So I get a lot, you get a lot of information every Sunday night, and you also get a course. So if you're not that familiar with options, you get a options master class. That's 3 sessions, 6 hours of comprehensive study in options. Now here's the kicker. The kicker is it comes with coaching, which means if you're looking at the course and you have any questions, hey, Jim, I'm watching session 3, and I think I have a question. What is it? No problem. Or I'm looking at the alerts, or I'm looking at the information in the report, and I got a question. What do you got? Or I'm in a pickle on this trade, or I'm thinking about doing this credit spread, or I'm thinking about doing this, or I'm thinking about doing that. And I just wanted to hear your opinion. No problem. What do you got? So it's very, very helpful. People have really enjoyed that because, again, they're all different levels of trading, newcomers, intermediate, and advanced. And I feel very confident with my knowledge and expertise in this that I can give a helping hand to all different levels and try to make you a better trader in 2025. So basically, David, I think, is having a link up there. So you can hit the link. Again, this is a very low price of $295 for 90 days. I mean, come on, that's a lot of information for 90 days. And finally, you can email me. So just go optionprofessor@gmail.com. Hi, Jim. This is Joe. I'm doing this. I'm doing that. Can you talk to me? Here's my number. Let's try to get together and see how you can help me. No problem. I'll call you back. We'll talk about it. If it's for you, great. If it's not for you, that's okay too. Again, what we're trying to do is help people, and if we can do that, we're going to do it. So, I always say this: if you're a customer, you're a friend, and if a friend calls up, obviously you're going to try to help them, right? So anyway, do take advantage of that. We also have a free booklet about how to sell, when to sell your option positions. I think that's very helpful, and that's free of charge. So do take advantage of that. My time's up. I'm going to bring it back to David. Again, this is Jim, the Option Professor. I hope to talk to you guys, and good luck and good trading.